Number one is often I find that allocators presume that India is a market to be timed, not a market to be held. And we've been speaking about that through this conversation, that this is not a market where you can time it. If you look again at these world-beating returns over the past quarter century, and you think about when those returns came, they came in bursts. This is not a straight line story of a market that went up 14% every year in dollar terms. Over a quarter century, it compounded at that rate. And there were long streaks when the market was up year after year. But there were some very brutal sell-offs, and you were paid to hold on. So I would say that the first point is that this is a market not to be timed, but to be held and to be owned.
This is allocating to India. Conversation for foreign investors thinking about the world's fastest growing large economy, with the allocators and fund managers actually putting capital to work. Views expressed are the speaker's own and informational only, not investment advice. Full disclaimer in the show notes.
Our guest today is Vikas Pershad, portfolio managers for Asian equities at MNG Investments in Singapore. Vikas has spent his career investing across Asia, from hedge funds and multi-strategy platforms to long only, based in Chicago, Hong Kong, and now in Singapore. That breadth gives him a particular vantage point on the question this show is built around: how a global investor should actually think about India, sitting inside a portfolio that has to weigh in against everything else. We will get into AI or semiconductor story that is quietly reshaping how Pan-Asia mandates are positioned. Why he sees India as a stock picker's market, the case for going below the large caps, and where he thinks foreign capital most often gets India wrong. Here's our conversation with Vikas. Vikas, you have had a very interesting journey from studying policy to investing. How has that shaped your career and investing in the Indian market?
What a wonderful and refreshing place to start. Thank you very much. I don't think I would be where I am if I didn't have the grounding that I do in policy and thinking about frameworks and coming at things from a non-traditional background when it comes to investing in the equity markets. What I would say is that there's a lot to say, but number one, when you think about investing, business school programs, a lot of coursework in accounting, in finance, they teach you to read the scoreboard, pay attention to the scoreboard. What is the revenue growth? What is the margin? What is the source of funding for something? And that's all very important too. But coming with a grounding in policy, I was first taught to read the rule book and understand the rules and understand the frameworks that directly impact public market investing in around the world, but especially in a market like India. In India, it's very difficult to separate the company from the state. And one area where my thinking has really evolved over the past few years is over time, I thought that as the market would grow and become more developed, more advanced, that there you would see a separation between the state and companies. If anything, we have seen a convergence of the two, whether it's GST, PLIs, RBI pronouncements and policies, everything is interlinked more and more. And so understanding the policies, understanding those frameworks is like reading the rule book, and then you start paying attention to the scoreboard.
Sure.
Grounding like this in public policy is very different from the usual background of coming from the business side or coming from an engineering side or a combination like we have. What do you think is the difference in that perspective? And when you talk to other investors, does that really bring a different outlook? And does it increase your sense of timeline and time horizons in your investing period?
Yes. So there's a few things to say here. Number one, when coming back to the scoreboard approach of looking at things, again, it's important to know the score. However, when you do that, you end up looking at screens, at quantitative factors. You look at the entry point in all investing, but especially in a market like India, which over the last quarter century has had the best track record for compounding, both at the aggregate market level, but then beyond the benchmark names in the small to mid-cap spaces. If you go back and you look at the market caps of the largest companies today and where those were 5, 10, 15 years ago, it's staggering, the compounding that takes place in India. And so when you have the understanding of the playbook first and of the rule book first, then it allows you to hold on to positions. It allows you to do all the important research up front. But in a market like India, holding requires a greater level of discipline than the initial capital allocation. So that is very important. I can give you several examples by sector. Defense, having studied defense policy, having studied the history of defense and armament around the world post World War II while I was in grad school, really helped me understand the context India was in 2022 when the conflict in Europe started. We became overweight the defense sector back then. We remain overweight the defense sector today. If I look back and I think about the re-ratings that we had envisioned, the earnings growth we had envisioned back then, 4 years ago, it has exceeded our expectations. But had I not had that understanding of the policies, the dynamic between Russia and India, the dynamic between Russia and other countries, how India's non-alignment over the last 70, 80 years has factored into that. And both of you have written about this in your investor letters as well. If had I not had that, I would have sold at the first 10, 20, 30% outperformance, most likely. And so that's one example. Second is hospitals and healthcare services. Coming out of COVID, understanding the direction the government was in, knowing that they acknowledged and understood that India's healthcare outcomes could not get to where they needed to be in the next 10, 20, 30 years without the private sector, has led us to stay with the hospitals, with the healthcare delivery companies as well. There are many other examples. You mentioned semiconductors and AI. It's a misnomer to say that India is the anti-AI market. Perhaps we'll talk about that later, but there's a lot of deep tech happening in India. There's a lot of companies that are investing very assertively in that sector and understanding the PLIs, the long-term subsidization, the fact that India's largest import might be oil, but the second largest is electronic components, and that is growing at twice the rate of oil. That leads us to very different outcomes, knowing all that. And so that helps us find a different kind of portfolio and then stick with it in the long term.
Sure. I think because you pointed out very correctly, India is a slightly different market. It's a non-aligned country. And so, how should a foreign allocator look at India? What lens should they use while looking at India? How much should they invest? What alternatives should they weigh? How should they consider the Indian market is an emerging market, is a satellite market? And how should they think about India as a market? Because I think many of our listeners would want to understand that question.
Great. So I'll say a few things. Number one is let's take a snapshot of where the global equity markets are today because the numbers have changed a lot just in 6 months. In rough numbers, the global equity market capitalization today is about $150 trillion US dollars. Half of that is the US, about 70, 75 trillion, pick your day. And as we speak, it's about half of the 150 trillion. The next 6 largest markets in the world are now all in Asia. And India, because of the dollar strengthening against the rupee, the relative underperformance to Taiwan, to Korea, to Japan, is now the 6th of those 6 Asian markets. But I'm hopeful. India's compounding story remains intact, and we'll see how that looks in a few years. But if you look at globally what the market looks like, 150 trillion globally, half is the US, the next 6 are in Asia. Now, when you look at the market cap to GDP ratios of those 6 markets in Asia, actually, if you look at the US also, they're very different from what they were just a year and a half ago. Korea has vaulted ahead of India. Taiwan has vaulted ahead of India. And the US is now over 200%. India is at 130%, which is high, but not nearly as high as some of these other AI-driven markets that we've seen. So that's one thing to mention. The second is if you look at South Korea and Taiwan today, over time, the markets should broaden, especially in South Korea. But essentially, these are AI-driven markets. If you look at the emerging market benchmark today, essentially, it's a semiconductor ETF that sometimes remembers that it holds banks in Bombay. That's what it has become. It's astonishing, really, that one company in Taiwan now has a larger presence in the emerging market benchmark than all of India. There's one nuance to that, explains a large portion of that. One, of course, is TSMC's outperformance. However, the second is that India has the highest average shareholding by founders, promoters as they're called in India, in the world. It's over 50% now. So if you adjust the free float for that, the roughly $4.5–5 trillion of market cap in India gets halved. So that's one nuance. That's another reason why India is underrepresented in the global indices. So then how do you construct a portfolio from that? It's worth reminding where we have come from. From roughly 2000 to late 2024, when the Indian markets were hitting their highs in September 2024, for nearly a quarter century, India was the best performing market in the world in local currency terms. And even in dollar terms, it was neck and neck with the US, compounded about 14% a year for nearly a quarter century. And this is how you end up with a market that started off with several $100 billion of market cap coming out of the dot-com bust and ended up with north of $5 trillion in 2024, start off 2025. One view that is foundational is that stocks follow earnings. And so when you look at the broadening and deepening of the market in India, the new listings that came, and the earnings growth associated with those companies, that explains why India was the best performing market in the world for so long. It was the formalization of the economy, shifting of revenues and profits from the informal sector to the formal sector, the premiumization, the broadening and deepening of the markets. And our view is that, yes, we've had this period of historic underperformance of India relative to other emerging markets. We have had this period of acute rupee weakness against the dollar, happening at the same time as other markets like South Korea and Taiwan and Japan have been hitting all-time highs. It's worth remembering that just 18 months ago, Korea was an unloved market. The volatility in the government, valuations were low, there's skepticism around value up. In the last 18 months, the market has nearly quadrupled in dollar terms. And the best performing market in the world, India, has now materially underperformed Korea and the broader emerging market universe, again, by the widest margin ever, going back to the 1990s. So that's the starting point. Our view is that this is a great starting point for genuine long-term investors because that track record that made it the best performing market in the world is intact. We should continue to see double-digit aggregate market growth. We have a very broad and deep market. One thing I've mentioned before is that the US market is essentially a tech-driven market. It's 7 companies. It's broadening out a little bit now, but in the past decade or so, it's been 7 companies, the max 7. As a result of all the IPOs that have happened in India, the growth that we've seen, the domestic nature of the market, you might not have the Mag 7, but you now have 7,000 listed companies. As an active manager with a long-term horizon, you have the Mag 7,000. Heaven for a long-term active manager. You're not going to find liquidity beyond the first few hundred, but if you are willing to take the long-term bets, get to understand the drivers of businesses, the drivers of those drivers, familiarize yourself with the management teams, which is essential, especially in a market like India. Then you have a very wide canvas from which you can construct a portfolio.
Building out on this thesis of Mag 7000 that you have articulated so well, see South Korea also now having primarily two companies that drive the market capitalization. We've seen Taiwan having only one company, literally with half the market cap. Where in India are pockets that essentially, for you, represent an anti-AI thesis, or are where growth really can come in the current environment also?
Great. Okay, this is a great point to build on. If you look at the composition of the key benchmarks and indices in India, they've evolved quite a bit over the past 15 years. If you go back to the 2010-11 period, coming out of the GFC, banks, IT services companies, oil and gas companies, so hydrocarbons, that largely dominated. And then you had some large staples companies as well. You look at the benchmarks now, MSCI India has nearly 170 companies now. And it's broadening out as a result of that, all the IPOs, and also, but as a result of the growth that we're seeing beyond the traditional benchmark heavyweights. This is a market where you get paid over the long term to look broadly, to look widely, do your homework, to do your diligence, and to look beyond, again, the historic large caps in the IT services and banks and consumer staples and hydrocarbon spaces. So today, we're in our portfolios, the largest overweight allocation is in healthcare, broadly defined. 10 years ago, you had a choice of one hospital, one, maybe 2 diagnostics companies, lots of pharma companies, yes, and that universe is broadened. Now you have dialysis companies that are listed also, medtech also. And when we think about the trajectory India is on, of the purchasing power of its citizenry, but then also in the context of some of the issues and the challenges that India has, the pollution, the shift in India from being a country where the disease burden is largely driven by infectious diseases to non-communicable and lifestyle diseases. Healthcare might be the clearest growth trajectory in a country that has a clear growth trajectory over the next 5, 10, 15, 20 years. And so that's one thing that I would highlight. That's one sector. where you have a broad and deep universe. But then you can go on and on and on. As we know, Make in India is a very large area of focus for companies and for the government. Whether you look at defense, auto parts and auto components, advanced manufacturing, there's a very wide universe of companies listed in India. And that's the appeal, is that when you're looking for dispersion as an active manager, the dispersion abounds in India. And that dispersion is alpha that hasn't yet been collected. Our business is in the relative return game. And for that reason, India is very appealing because the divergence between the best performers and the worst performers in most sectors is the widest in the world. And so that dispersion is very helpful to active managers looking to outperform the benchmarks. And that's true for sector after sector, as we just mentioned. And that's what makes India very appealing. The liquidity is improving. I should also add that for those investors who are able to use futures and options, it's the most liquid market in the world for futures and options. The oldest stock exchange, or the first stock exchange in Asia, actually was in India. And it's a well rooted history and culture of equity trading. And you build on top of that the futures and options market, which again is the most liquid in the world. The exchanges are transparent. They are retail investor friendly, but institution friendly also. I should add that the RBI and SEBI are perhaps two of the more future forward and forward thinking regulators and policymakers in the financial space anywhere in the world. And so you put all that together, and it's a very good market for long term investors.
Sure, makes sense. Because we've also seen consumption growing in India a lot. Like US, India is a economy which is driven by internals. It's not so much of export-driven economy. So what's your view of consumption and how it has evolved over last 20, 25 odd years? And what are the things which you're seeing which could be interesting from an investing perspective?
This is an important question, and it builds on the previous one about how the market has evolved and what does it look like today. The consumption story in India often gets confused as one of volume, and there are some sectors in which that has been the case. Consumer staples is a good one. Over the last 20 years, volumes have largely driven that. But the underlying nature of the market has changed. The drivers of growth and of earnings have changed. And it's now one of formalization and premiumization. We just talked about healthcare. That's a good example of a shift from the informal sector, the government sector, to the private sector. The willingness and the propensity of India's citizens to pay more for high quality healthcare. But you're seeing that in the automotive sector. You're seeing that in the travel and leisure sector also. So when it comes to the consumption sector and the Indian consumer, this is not a market of 1.4, 1.5 billion consumers, not yet. My hope is that one day it will be. But really, what is driving consumption, or the factors and the capital that are driving consumption, are concentrated perhaps in the top 100 million households, which is maybe 3 to 400 million people at the high end. That is what is driving. So when you slice up the consumer base across those different cohorts and you focus on the higher end, that trend towards premiumization, the K-shaped recovery that we saw coming out of COVID, becoming a K-shaped economy, that's where we have concentrated our capital in sector after sector. And also coming back to the point about dispersion, and for allocators who are based, who are judged on relative performance, in a market like India, where the long-term equity compounding story has been so strong for so long, and looks like it will continue to be strong for the next 5, 10, 15, 20 years from here as a starting point. Knowing what to buy is very important. Knowing how long to hold it is very important. But also knowing where to take your capital away from and where to be underweight is crucial. And there's a lot of alpha there also. Yes, in some of the small and mid cap names, but there's a lot of alpha on the underweight side in the large cap names also. If you look at our portfolio over the past few years, we've benefited from being underweight consumer staples, from being underweight IT services, from being underweight some of the hydrocarbon names. And this shift away from banks towards NBFCs, some of the insurance names, non-bank financials, which is a very large category in India and has become more of a driver of stock prices than the large cap banks, which 5 to 7 years ago, I would have been very surprised to see. That is happening as well. So when we think about India as a market for capital accretion and compounding, coming back to the earlier part of the discussion, knowing what to buy and hold is very important, but also knowing what not to buy and where to take your capital away from can save you a lot of money and add performance to your portfolios as well.
Yeah. You also touched upon IT, and that brings about the most important topic which allocators are looking at India, right? Which is the AI. Now, there are no AI infra plays per se, pure infra plays in India. And people and allocators and globally, everybody is thinking that more and more IT services may shift to AI, and hence there is underweight of IT, and that's why maybe you may also not have invested in IT, and people are expecting that IT services may get impacted, and it also may have a second order impact on consumption, on real estate in cities like Bengaluru or any other IT kind of hub. So, what is your view of IT and India? And given that it's such a hot topic and it has increased the weight of Taiwan and Korea so much that it's the talk of the town now.
Yes, there's a lot to unpack here. I would say number one, when we talk about IT services, any sector really, but especially IT services, a lot of companies get grouped together that are very different businesses. So the first point I would like to make is that IT services in India is not a monolith. There are dozens of companies that you can tag as IT services, but the business models are very different. And this is why understanding the management teams, the track records, the long-term goals, the drivers of revenues and costs and profits matters a lot because there's a lot of dispersion within that. Even in the headline underperformance of the IT sector over the last couple of years, you've had a lot of dispersion. Some companies, some stocks have actually done well. Some companies have actually done very well, but they have been derated. And we think that there's an opportunity there also. So while we might be underweight the sector as broadly defined, we do have some exposure. We are overweight a couple of names, neutral some others, but largely we are zero weight or underweight most of the names. And in aggregate, we are underweight. We've only marginally reduced that underweight in the recent times, given the years-long underperformance of that sector. But that is one point to mention that, and this relates back to the MAG 7000 concept, that there's a lot of dispersion or uncollected alpha to be had in every sector, and this is one of them. Second, what I would say is that yes, the headwinds are real for a lot of the large cap IT names, which is why we are underweight them. There's revenue headwinds. The cost structures are not yet ready for the new AI world that we're dealing with. There are some opportunities for them for the large cap names as well. If you look at the AI portions of their revenues, and every company defines this a little bit differently, but growing very rapidly in the context of a market overall that is not growing all that fast. What I should add though is when you look at that growth over the last few quarters and what is projected for the next couple of quarters, it is worth remembering the currency impact. Most of the revenues are not rupee based; they are dollar or euro based. Rupee has weakening, so if you adjust for that, the growth is actually even more anemic in the near term than it looks. But again, this is why it's important to do the homework. There are opportunities for these companies for more software is needed for many of these hardware applications. As more and more companies integrate AI into their processes, it's very important. That said, so where are the reasons for hope? Number one is the wide scale adoption that will happen in India of AI across sectors. It was 3 years ago that one of the cement companies in which we had invested highlighted that they started using AI and advanced hardware to track their cement delivery trucks, and as a result of that, fuel consumption went down, their margins went up. So on a similar revenue base, they were more profitable because of AI adoption. You're seeing a lot of AI talent shift from the IT services companies to semiconductor design firms and software development firms for these AI companies. They might not be the AI is going to dent the earnings trajectories for existing models, but there's a lot of AI related talent in India, and I wouldn't want to be short that. Another point to make is that there are lots of companies that are investing in AI or associated industries today, the power transmission and distribution space, cooling, back-end semiconductor manufacturing. There's been some very notable tie-ups between Indian companies and Japanese companies, either through acquisitions of Japanese businesses or the transfer of IP and people to India to help build out these industries. These things take time. Yes, the rally over the last 18 months has been staggering, or even if you go back to December of 2022, shortly after ChatGPT was launched in November of 2022, less than 4 years. But the industries that are benefiting from that took decades to build. I don't think it will take decades to build those same industries in India. The government is very focused on it, companies are very focused on it, but these things take time. Meanwhile, as the market has shifted a lot of capital to South Korea, to Taiwan, to AI software names in China, a lot of Indian sectors have been derated while the earnings growth has been intact largely. In the short term, of course, there's some hiccups because of what's happening in West Asia, because of what's happening with the rupee. But I would say that the Indian earnings have been very resilient. Also, one thing that we've not yet touched on is when it comes to how this microstructure of the market has changed in India over time. Yes, the promoters or the founders still have about 50% of the market, but the rest of the 50% looks very different today. This is not an FII driven equity story any longer. This is a domestic growth story driven by domestic investors. And the systematic flows that come in every month on the order of about $3 billion plus or minus, they have held the market up. And that looks like it will continue. Might the flows go down a little bit? Perhaps. They could even go higher. But this is a very domestic market, both from the revenue and profit.
About India, where we talked about the consumption, we talked about the IT services and NTI trade. There are also things like currency and exit mechanisms and regulations, which a lot of allocators would want to understand. So, what are your views on things like those, and where are foreign allocators get India wrong on these elements, which is currency, which is regulations, and which is like exit dynamics, where they need to learn more about the Indian market and maybe about the Indian culture per se, because I think some of them are linked with the Indian culture also.
Yes, okay. A lot to say here. Start with the one concern that a lot of allocators have when they consider investing in India. I often get asked what my concerns are, that I've chosen to devote a substantial portion of my career to this one market. Why and what are my concerns? Typically, I will answer their question with a question. What are your concerns? And normally, what I hear in response is valuations, number one. Second is, after so many years of political stability, is there a risk that we might not have stability? Who will the prime minister be when there's a new prime minister one day? And then third is FX. I would say that all those are considerations. We can get to my genuine long-term concerns later, but and FX is becoming more of a consideration now. But let's start with valuations for a moment and come back to why optically they are so high, because this is a hurdle for a lot of allocators. Number one, coming back to the earnings growth story, the Indian earnings growth story has been the best in the world for a very long time, or had been up until the recent turmoil that we've seen with FX and commodities. And I think that story is intact. But when you have the highest earnings growth rate in the world, and within sectors, you have sectors and companies that are growing much faster than the aggregate growth rate. When you have the highest earnings growth rate in the world and you have the highest ROEs in the world, you're going to have high starting point valuations because those companies will grow into those multiples pretty quickly. A 1 year forward PE is just a snapshot. You need to play the movie forward and see what those multiples become. And given the high growth rate, the multiples come down pretty quickly. And this is one lesson that I've learned, unfortunately, is that a PE is one output. It's one element of investment analysis. It should not drive your thinking because that can lead you to the wrong outcomes. In India in particular, but this is true everywhere, a low multiple does not necessarily signal cheapness. And a high multiple does not necessarily mean that something is expensive. And there's a distinction to be drawn between those two concepts, which I learned largely as a result of work in India. Being pricey and expensive is not the same thing. If you pay a high price, but you're getting value in return, that's not expensive. You're getting something in return. A security is expensive when you don't get something in return. A very low PE multiple or low PB price to book multiple can indeed be very, very expensive over time. If there are issues with growth, if there are issues with regulations, if there are issues with corporate governance and malfeasance. In contrast, our best investments have historically optically looked very expensive, very pricey for years. But that's because their moat has been so wide. The unit economics have been so strong that they have continued to compound over time. So I would say that that's one thing that is an ongoing conversation with capital allocators. And the evidence is in the best performers. You look back at best performers on any extended time period in India, and it will be a collection of the companies that have high earnings growth rates, high ROEs, high returns on invested capital, and probably have a disproportionately high expenditure on R&D as well to fund future growth. It's the companies that are too conservative with their spending. It's the ones that have corporate governance issues or that have challenges and real headwinds that keep the multiples low and for good reason. And so I would say that that's number one. Second is if you look at the valuations, there's another reason why they are high in India. And that's because it's difficult to get capital outside the country. So these systematic flows that we talked about, the several billion dollars every month, there aren't very many places for that capital to go. It's not as easy for somebody in India to invest in a US tech fund or in Japanese equities or Korean equities. So the money stays domestically, and that keeps a floor under valuation. And it also provides a bid during periods of volatility and turmoil. On that subject of volatility, I would say as a long term investor, volatility is our friend. There have been many instances of volatility just over the last half dozen years. If you think back to March 2020, when COVID started spreading around the world, you think about the conflict in Russia and Ukraine starting in 2022, the Liberation Day, as President Trump called it in April last year, or this year when we saw the situation in West Asia start. That's just four, but there have been more. And each of those four instances set us up very well for prospective returns in every market, but especially in India. The issue that we have is volatility and how quickly markets have been moving. And that is something that rewards patience and persistence. One thing that has worked for us and we have learned in investing globally, but especially in India, is that the time horizon arbitrage is not by trading in shorter and shorter increments. It's going in the other direction and thinking of the long term. And going back to what we were talking about earlier, that in India it's very important to know what to buy, but it's a great discipline to know what to hold and how long to hold it. So I think that's something else worth highlighting to long-term capital allocators, is that India is the one market in the world that most rewards you for holding on and for having a long-term perspective and understanding why valuations are what they are. When earlier in my career, one thing that we used to do was we would look across Asia and say, well, Japanese consumer staples companies trade at these multiples. Indian companies are much, much higher. We should be underweight the latter, and we should be overweight the Japanese companies. Or the same thing in banks, the same thing in automotives. Look at car manufacturer multiples in India versus any other sector, any other peer group around the world. It's very, very different. That doesn't work. We need to understand the nature of the domestic market, the domestic consumer, what's driving earnings, what's driving flows in the short, medium, and long term. And so that's something else that investors need to understand. Also, just on the regulation side, coming back to my point about the RBI and SEBI, I do think that they are transparent. They're there in the room when all of us cannot be. And they're thinking about us as institutional investors. They're thinking about the retail investors. So I have my faith that in the long term, they will do the right things as well. And so that's something that gives India structural advantages on top of everything else.
Wondering as to what are the conversations that foreign allocators are not having, but should be having when they're thinking in terms of the long term investing in India. One of the common grudges that we heard was that India has been a perennial bridesmaid. People came in different years and then they did not get the returns and then they went back. We're talking about the 90s and then again 2010, the same period. And now we are again seeing an exit for the investors from India in the last couple of years, especially the last year has been quite violent and they've become underweight in a certain way. What is the biggest holdback that you think they have, apart from the fact that they are getting other opportunities? Someone called India even a boring market in a conversation that we had.
People are always like from 2005-6 onwards, it's India is the next big story, and it always disappoints the optimist and always disappoints the pessimist. So it's that kind of a market. So what are the foreign allocators kind of missing in India?
There's one important point here about how we approach investments across the region and around the world, but especially in India, is that we are always fully deployed. The reason for that is we manage other people's money. Our view is that if others have allocated money to us for India, they have taken that call. That's the exposure that they want. And so we typically will have no more than 50 basis points of cash, so 0.5% of cash in our funds. Sometimes it's lower than that. When we saw the peak of the volatility in February and March of this year, that was another example when we had even less cash than that. And the reason for that is because if you look at India's equity returns over the past quarter century, they've been world leading in local currency terms and in dollar terms, but they've been very concentrated in a period of a short few years. Most of the returns came in bursts. Of course, we don't know when those bursts will happen. And so when you have a long-term compounding story at an aggregate level, and then you go into the sectors and the companies, lots of dispersion, the winners being rewarded with multiple returns that are multiples of the market overall. then you need to stick with the market. And you can get around that through sizing, but allocation to India in a global portfolio or a regional portfolio from here as a starting point is a very promising proposition, is our view. And what I would say is that because we don't know when those bursts of the returns will come, we stay fully invested. And I think that's important. And when you look at the underlying drivers of the economy, of equity returns, of earnings, I think that that justifies long-term investments. In investing, we often talk about North Stars. Mine for India is this, that we should assume that over the next 20 years, let's assume that the economic growth is about 7% a year, plus or minus. In some years, it might be higher. Some years, it might be a little bit lower. This year, it looks like it'll be a little bit lower, given what we're seeing in West Asia and in other parts of the world. But let's just assume that that's the case. As a $4 trillion economy today, as a starting point, if we grow 7% a year for 20 years, or let's say 25 years, that means that the market should roughly double and then double again, or the economy should double and then double again. So you have a $4 trillion economy that doubles to 8 trillion and then double again to 16 trillion. As we were talking about earlier, the market capture to GDP ratios around the world, then what is 130% now? By the time India is a developed market, let's just assume, because we're hopeful, because we're optimists, that it becomes 200%. So you will have a $16 trillion economy on 200% market capture to GDP ratio. That takes the total market cap of the country to north of $30 trillion. We're at 5 trillion today. That's a lot of wealth creation to come. But capturing that wealth creation requires a long-term investment view, and it requires infrequent trading. It requires a lot of discipline and research time spent up front, and understanding of the key companies that lead you to the right winners and keep you away from the losers. But that, for me, is something that I hope puts some evidence or some numbers to the story that is the Indian equity story. There's a lot more to talk about there, but what I should say is that I think that the market will not peak in my career. In the short term, of course, we're going to have ups and downs. And yes, in the short term, you could say that the market did peak in September 2024, but the market will be back. When you look at aggregate earnings growth, you look at the formalization of the economy, you look at the dispersion, you look at the winners over time, and the long-term investors will be rewarded for sticking with this market.
Sure, that makes sense, Vikas. Interesting question here. You've seen multiple cycles. You have seen India from so many years. So where have you changed your perspective significantly about the Indian market or about the Asian market? And a related question, which is maybe what was the hypothesis about the Indian market which you held 5 years back, which you are pleased that nobody has recorded it and it's not on the tape? Those are some little tidbits where those are the information which our listeners would want to know.
Well, it's going to be recorded now. So it wasn't recorded 5 years ago, but you're going to expose me now. But we'll get to that. Well, let's start with your earlier questions on how my thinking has evolved. We've touched on a couple of these earlier. One is not using price as a starting point, really doing your homework and getting conviction, and just fundamentally believing that long-term outperformance, or long-term performance and then long-term outperformance is highly correlated with conviction, is inversely correlated with trading frequency, and with the number of times that you change your decisions. Meaning, focus on the long term, not on the short term. Don't trade often. Trade just because we can trade every day doesn't mean that we have to. And don't use price as a starting point. Don't use valuation as a starting point. Of course that matters. Of course the price that you pay matters. It matters less and less the more conviction that you have. It matters less and less the longer your time horizon is. But not using a starting PE as a screen, that's going to lead you to wrong investment outcomes in any market, but especially in a market like India. As I was saying earlier, if you look back over the last X number of years, the best drivers of performance of where we have been overweight have been companies that look optically expensive, and they have always throughout that holding period and still do today, but they continue to grow into their multiples. We were talking about the power sector earlier. If you look at the transmission and distribution sector, some of the companies that have gone up about 10x over the last 3 years, they have maintained their multiple. It's because earnings have gone up by 10x. You can take a differentiated view on what the prospective earnings look like from here and what the right multiple looks like from here. But throughout that journey, they have looked very expensive, but they ended up being pricey, not expensive. Come back to the point earlier. So I would say that those are some of the lessons that I've learned about not using price as a starting point, focused on the long term, trading when you have to or when you need to, but not when you can, just because we can trade all day, every day. I would say another lesson that I have learned, and this is tied to the point about the uniqueness of the Indian market in that half of it is held by founders or promoters, is that access can be a trap. Admiration and affection does not equal analysis. What does that mean? Is that in a market like India, where a lot of the market cap historically has been in a small cohort of companies, and the outperformance has been in small and mid caps, just astounding returns. It's imperative to understand the motivations and the background and the execution ability capabilities of the founders, of the people around them. And to necessarily, and I've spent a lot of time with promoters, with management teams, and what sometimes that can get way in the way of dispassionate analysis. You need to separate the process from the returns. You need to separate the people to the extent possible from just rational capital allocation. So I think that's something also that I've learned largely in India, but in other markets as well, is that access can be a trap. You have to be very rational. And then the third major lesson, and this comes back to where we started this conversation today about policy and understanding frameworks, is that the macro is very, very important, but our job is stock picking. If I get lost in prognosticating where the rupee will be or where the interest rates are going to be, that's going to lead me to suboptimal investment outcomes. Our focus is on stock picking and trying to outperform the market and generating high absolute returns, but high relative returns as well. And we give a lot of scrutiny to what we own and what we are overweight, but then also to what we don't own and where we are underweight, because the underperformance in a market like India is highly concentrated. If you look over the past few years, nearly 2/3 of the market in the years leading up to 2024 when the market was peaking, nearly 2/3 of the market by name count, the benchmark by name count was outperforming. So if you got that 1/3 right and you were underweight that and you reallocated capital to the winners, that alone was a great call. So stock picking really matters. And as the investment universe grows from, and it has grown from 4,000 to 5,000 companies, 7,000 companies and beyond, stock picking will matter even more. India is perhaps the most overbroked market in the world. If you look at a lot of the large cap names, they will routinely have 50, 60, 70 publishing analysts to cover them. But now that you have 7,000 names, and let's say the top 200 names probably account for 85 to 90% of the market cap. But in that 10 to 15% of the market cap that is represented by all the other hundreds and hundreds of companies, there are a lot of gems that will compound over time. And it's very exciting to be part of this journey to find them.
Yeah, makes sense. Coming to the question, what was the hypothesis which you held 5 years back? And I think your perspective has changed. Some of the things which you talked about, I think, do fit in there, where it's not that important. I think the earnings growth is important. So, what was something which you realized over last 5 years, which has now evolved and made the Indian market more interesting? I think your theory about the 7,000 stocks and a lot of IPOs would have come through, could have been an input there.
Yes. So there's that. Also, I had thought that active management would become tougher and tougher as ETFs took off. But what I find is that with this growing universe of companies and with our approach and our focus on gaining conviction, and by the way, I mentioned the importance of conviction earlier, but I didn't define it. Our view is that conviction is the ability to differentiate between signal and noise. And that comes through a lot of hard work, a lot of legwork, a lot of thought. We have wonderful tools now with AI, various LLMs. I use them extensively, and that has increased my productivity a lot. But that's all to drive conviction. If you think about investing as happening in three phases, there's information gathering, analysis, and judgment. These new tools are really helping us with information gathering, with the analysis, freeing us up to think about judgment. And that's where we spend our time. So that one assumption that I thought hasn't come through, fortunately, is that active management would become less important or would become even harder with the rise of ETFs. That hasn't happened. One. Second is just thinking about your question. The most expensive sentence in Indian investing is, I'll buy it when it's cheap. And understanding that, again, this is something that I'm glad I was wrong about, is that the high multiples don't mean depressed returns. If anything, the highest multiples can mean staggering returns over time. Now, when it comes to certain sectors and areas that didn't really play out, I would say one is coming out of COVID. I had thought that technology would accelerate the growth and the adoption in certain sectors, education most of all, and that has not happened. We're still on the look for beneficiaries of this increased spending in education. It has happened in healthcare. We have benefited from that. But earlier we were talking about cement companies even adopting the use of AI. And you think about where is demand inelastic in India, in Asia, around the world. Education is one of them. But it's puzzling to me that there are no mega cap education companies anywhere in the world. There's some listings that have happened. There are others on the way. But I think that's one thing that I got wrong, that I was back to, and even in the benefit of hindsight, I think that I made some wrong calls there, but lessons learned, and on balance, we benefited. We've gotten more things right than wrong. But that's one thing that, if I look back, I'm glad wasn't recorded then, but you just did now.
Yeah, any choice because investing is a probabilistic kind of approach, right? So you get some right and you get some wrong. I think the hope,
Yes.
as Federer pointed out, is that you just need to get more right than wrong. Given that he won 54% of his points, but still won all the Grand Slams. It's the very similar thing is applicable to investing, where you need to get more rights than wrongs. And all portfolios would have some wrongs or the other. I think it's just impossible to avoid them.
Yes. But to have more rights than wrongs, and also to be sized appropriately when you are right, and to be sized appropriately when you are wrong. It's okay. We're going to get things wrong. Even a world class hit rate might be 60%. But what's more important than the hit rate is the slugging ratio, or how much you
Yeah.
make when you're right and how much you lose when you're wrong. And this is why then, coming back to the point that yes, there's a lot of excitement in the off benchmark space. There's a lot of excitement beyond the Nifty 50 stocks, but you really have to do your homework. And this is where the value of active management and having a robust process and having a long-term horizon really pays off over time in order to capture that alpha.
Sure, that makes sense. Our final question, Vikas, what are two, three things which foreign investors need to have a conversation about India? And they are not talking about India. Is it geopolitics? Is it any other thing which you think they should be talking about India and conversations about India, but they aren't having that right now?
I think, well, there are two, I would say. Number one is, often I find that allocators presume that India is a market to be timed, not a market to be held. And we've been speaking about that through this conversation, that this is not a market where you can time it. If you look again at these world-beating returns over the past quarter century, and you think about when those returns came, they came in bursts. This is not a straight line story of a market that went up 14% every year in dollar terms. Over a quarter century, it compounded at that rate. And there were long streaks when the market was up year after year, but there were some very brutal sell-offs, and you were paid to hold on. And I think from here as a starting point, you'll be paid to hold on. So I would say that the first point is that this is a market not to be timed, but to be held and to be owned. This is how we approach every company that we invest in. That we are owners in a business that somebody else started. It's a privilege. It's a privilege to manage other people's money. It's a privilege to be an owner of something, of a business that somebody else has started. But when you think of yourself as an owner, not a trader, that leads to different outcomes. And I would say that it leads to better outcomes. I think the other conversation worth having is just acknowledging what India is, what the benchmark is, what the listed space is today, where it has come from, and where it's going. And that's very important. If I look at the largest underweights in our portfolio today in aggregate, IT services, uh, consumer staples, some of the hydrocarbon names, and then also it's not an underweight, but relative to where we have been in the past, we have a much lower allocation to private banks today than we have had. If if I look at my portfolio in India from 5 years ago, in the middle of COVID, or 15 years ago, it would have looked very, very different. So I think that's another conversation we're having, is just acknowledging what is on offer in India. I know that there's a lot of excitement in North Asia right now, but that is a market that is very narrow. South Korea, as you highlighted, Saurabh, is a very narrow market. More than half the benchmark is two companies with a very volatile track record of earnings histories. And right now, things look very good, but things have looked good in the past as well. And those good periods were followed by fallow periods. Same thing in Taiwan. The last time I looked at it, there's about 1,000 companies in the TWSE, on the TWSE, and 40 companies accounted for about 71% of the market cap. And those 40 companies are the ones that you could tag as being AI driven. And so that is a very narrow market. India is not a narrow market, and it will become less narrow over time. And I think that this is a market, if you are willing to invest time to do the research, to meet the promoters, to understand the drivers of key industries, to understand public policy, to understand how to look, not to just look at the scoreboard, but to understand the rule book, then this is a market worth having an allocation to. If you have none, you should have some. If you have some, you should probably have some more, especially from today, given where we are with a currency that is much cheaper than it used to be, with a market that has underperformed relative to other emerging markets. And I think one other conversation worth having is just on this phrase itself of an emerging market. As an equity market, as a capital market, in many ways, India is a very developed market. If you look, coming back to the regulators, you start with them. You look at the liquidity provided by stocks. You look at the transparency of the exchanges. You look at the futures and options market and how liquid that market has been and continues to be. And then coming back to the point that the first stock exchange in Asia was in India. This is a highly developed market when it comes to the equity markets. I have less familiarity with the credit markets, but in India, it's really an equity market story for now, not so much a credit story. So this is where should we should be looking. And so I would say that the third conversation to be having, in addition to the first two, which is not a market to be timed, it's a market to be held. Second is just understanding the many Indias, whether the drivers of earnings, the formalization of the economy, but then also looking at how that is represented in the benchmarks and how that will evolve over time. And the third is this: that as a market, as an economy, India is still developing, but as a capital market, as an equity market, it has developed. It is no longer emerging. It is here. It is present. And for long-term investors, I think this is a very exciting market. Unpredictable, but worth it. And if I look at the world today, there's a lot of volatility. There's a lot of uncertainty. There is always volatility and uncertainty, but it seems heightened now. Some things do look distorted to me. The fact that one company in the US that makes GPUs has a market cap larger than all of India, that looks a little distorted to me. There will be 3 companies listing in the next few weeks with an aggregate market cap that might equal all of India. As a long-term investor, if I were to bet on India versus those 2 options, I choose India. And I hope that many of your listeners will at least enter that conversation and over time choose it as well.
Yeah, I agree with you, Vikas. I think India is in the equity market, it's very developed. There is robustness in regulations, and hence it should be one of the markets which global allocators should pay heed to and should look for the long term. India is a diversified market and it has a lot of opportunities, especially for the active investor, as you correctly pointed out. Thanks so much for the conversation, Vikas. It's been quite useful. Good
My
to be
pleasure.
with you.
Thank you very much. Likewise.
Thank you.
Thank you.